Hello and welcome to the Friday market update. Are we there yet? Mortgage rates dropped again, but you know that feeling. You're on a long road trip, your kids in the back seat, bored out of their mind, and they keep asking the same question. Are we there yet? And I have a 5-year-old son and a long road trip to him, 10 minutes, and I hear it like 5 times. Anyways, well, that's what the mortgage market has felt like for the last year. Rates have been high. The Fed has been stuck, and all of us, buyers, sellers, agents, have been sitting in the car wondering, are we there yet? We're not quite there yet, but today we got some really good news. We're not fully there yet, but we're finally seeing the exit signs. So the infamous BLS jobs report dropped this morning, and for the first time in it seems like forever, it didn't wreck the party. In fact, mortgage rates improved this week, which is awesome. Conventional loans are now around 6.63%, according to Mortgage News Daily, and that's for well-qualified buyers. FHA and VA loans are now down near 6.25%. And if the FHA or VA dips under 6%, which we're not that far away, watch out. This stampede is going to come. So this is a kind of momentum that wakes up buyers. And if your clients have been sitting on the sidelines asking, are we there yet? It's time to start saying, we're almost there. We're almost there. My favorite subject, of course, is the BLS report because I make fun of it all the time. So let's talk about it. The Bureau of Labor Statistics releases jobs reports every month. And every month, Wall Street just clutches itself and it's like the gospel. It's like a holy grail. But here's the thing. It's not a map. It's a guess, man. It is a bad guess. And it's like getting directions for someone who's never actually been there. Just drive down the road, take a right turn at Gaylord's Diner, then go a couple of miles or so, turn left on the dirt road. And then when you see the cowbells, then you should be close to your destination. Well, the BLS jobs report is full of estimates and adjustments and seasonal voodoo. Then later they go, oops, never mind. I meant to say take a left at Gaylord's Diner, and they fix it with a more accurate report called the QCEW, and that's based on real payroll data. So last year, the BLS said we added 2.5 million jobs. That's a lot of jobs. But actually, when the QCEW cleaned up the BLS monthly reports, it was off by 1.2 million jobs. So let me say that again. They were off by 1.2 million jobs. Now, that's a lot of wrong turns. They were not driving in the right direction. These jobs never existed. So no wonder we've all felt lost. The GPS for the Fed has been wrong virtually every single month. Now, the good news, today's BLS report came in at 73,000 jobs. This was well below the 110,000 jobs expected. But the raw, unadjusted number, 1.07 million jobs lost because they adjusted seasonally. And it gets better, or worse, depending upon how you look at it. The reports from May and June just got major downgrades. The May jobs number went from 139,000 when it was initially reported. Now what they're saying, it was only 19,000. The June jobs went from 147,000 jobs. And by the way, we counted on that. It's only 14,000. This is well over 250,000 jobs in just 2 months of revisions. These are major misses, and they pushed interest rates unnecessarily higher at the time the reports were initially released. Whew. So if you felt like the car hit a speed bump back in May and then a huge pothole in June, it did, and it never should have. Now, the truth is starting to catch up. The real data has to catch up, and that's what we've been waiting for. And rates are finally moving in the right direction. Are we there yet? I hope so. The household survey, which is another part of the BLS jobs report that feeds into the unemployment data and the unemployment rate, showed job losses, 260,000 job losses. That's different than the $77,000 gain. Now, that included 440,000 full-time jobs wiped out, gone, but 247,000 part-time jobs added. All right, is anyone confused yet? Clearly, the Fed sure is. That's not growth, that's survival. It's like trading your comfy minivan for a moped. Yeah, you're still moving, but it's not the same ride. You might get lost a little bit. So let's check in with our backseat driver, the Federal Reserve. They met again this week, and shock of all shocks, guess what? The Fed funds rate was unchanged again. But here's the plot twist. There are two Fed officials that voted against it. They dissented. They did not agree with the other people with the Fed in keeping them the same. And this hasn't happened. There's never been two Fed officials that have dissented in over 30 years. So usually all Fed members go into the room, they meet, they talk, they come out, they all nod, they smile, and they follow the leader, Jerome Powell. Not this time. There's definite division in the ranks, and it's clear some of them are finally seeing the warning lights on the dashboard. Blink, it's starting to blink. If the next report confirms a slowdown, guess what? I predict we're going to see a rate cut on the Fed funds in September. Now remember, when the Fed moves the interest rate down on the Fed funds rate, it doesn't mean that mortgage rates will follow, but it often does. If you look at history, the mortgage rates generally will follow the Fed funds rate downward. So if you're wondering, are we there yet? We're definitely pulling into the neighborhood. So what does this mean for your clients? You need to have an action, a call to action for your buyers right now. So here's a big takeaway. Buyers waiting for that perfect moment might miss the window. Sellers are still offering credits, concessions, rate buydowns, but this may not last for long if the rates continue to move in this direction. If we hit 6.5% on the conventional, which we're really close, we're 1/8% away, or under 6% on the FHA VA, this is a huge psychological shift even further for some of the buyers that are locked into their current interest rate, or those that the payments were a little bit too high from an affordability standpoint. They're going to jump back in. The shoppers are going to return. The bidding wars could start up again. And that free money that the sellers are giving out right now, that could disappear. So let your buyers know now. Would you rather buy while sellers are negotiating, or when the line's out the door like it was a few years ago? Gosh, negotiate now. Take advantage. Let's go out. Take advantage of sellers this weekend. And by the way, taking advantage of sellers, they're still making out like bandits as they have a pile of cash in the equity from their home. So honestly, everybody wins. The buyers coming in get some free money from the seller who made it over the last few years, and the sellers win because they get to move on and take advantage of the next seller. So this is a time to act before everyone else sees that exit sign that says, welcome to rate relief. Rates have dropped. If you or your clients need a game plan, I'm here. Let's run the numbers, explore options, and make sure they're ready for what's next. Be the buffalo, charge through the uncertainty now. We see certainty that others don't. We see what's happening, and it's happening. Because when the sun does come out and rates are lower, the entire herd will follow. That herd will be there too. And to those still asking, are we there yet? I'll say this, almost. Get your bags. We're exiting soon. This is Gaylord out. Hope you have a great weekend. We'll see you next week. Bye-bye.